All right, folks, welcome back. I apologize for not being able to upload a video last night, but things happen in the real world. It was unavoidable, and it was something that was a little challenging. I had two of my boys that live with me and my wife, and without Wi-Fi, I mean, obviously they have Wi-Fi for their phones, but they like to play on those Xboxes and things like that, and my youngest son does little streams for his video game club, and he wasn't able to do that. So I was having to navigate all those emotions and wanting to be obviously plugged back into the matrix. But we got set back up later on this afternoon, so hopefully we won't have any more glitches with that. But I'm going to go through this rather quickly because I didn't have an awful lot of time, because I have this video and I have the YouTube video, and to make up for what you're not getting today, I'm going to be teaching you a high frequency trading algorithm tomorrow. So don't think it's a consolation, because I was going to do it anyway. I'm just trying to sweeten it up because I had a technical problem last night. So, all right, so we're looking at the dollar index. I'm going to go through this rather quickly without drawing too much detail from anything, because I'm literally looking at the charts, fresh right now, and I don't have a chance to really sit down and spend more time with it, except for the fact that I'm still looking for lower prices. I like the buy side and balance, sell side and efficiency here. I like the sell side liquidity pool. I like the fact that we traded up into the fair value gap in here, and I would have rather seen a little bit more decisive candle, not something like this today. But given the economic news that came out, obviously, this was the biggest economic driver of the week. You can see that in the indices as well. I'm going to cover indices here tonight. I'm not going to do it on the YouTube channel. The reason why is because you're going to get the higher form of the analysis concepts that I teach. And I kind of want to refrain from teaching what I'm going to teach with you from that perspective on the YouTube channel. So I'll cover Forex a little bit more detailed on the YouTube channel tonight, because that's what I'm going to be teaching there, how to use the algorithm I'm teaching there with Forex, not just the futures market. All right, so lower prices, I'm expecting that, and I don't think we'll need to come back up here. If we do, then we're in bigger trouble. I think that'll be war related. So the high gets taken out if war becomes a factor. Otherwise, I'm weaker on the dollar. All right, the daily chart on the euro dollar. We had a SIBI here, sell side imbalance, buy side inefficiency, relative equal highs, and the market reached up into that. I would have rather seen it trade a little bit more into that range, this range right here. But hey, it is what it is. You can't force everything. So we'll look at this logic. Just know tonight, which I'm not going to cover in the YouTube presentation, but when I cover the euro yen, that's the cross I'm going to teach with tonight, just know that the mentorship version here is the fact that we traded down into this buy side imbalance, sell side inefficiency on the euro. So when it did that, it swept below here for sell side liquidity, came back inside this imbalance, and then started that run higher. So that's the justification for why euro yen. I'm not sure if I said euro yen or euro pound. It's euro yen that I'm going to be teaching with tonight on YouTube. But the bullishness that would be seen by taking out this swing low here on euro dollar, also trading into the buy side imbalance, sell side inefficiency, that is the underlying pinnings of why euro should go higher. Okay, so I'm not going to teach that there in the YouTube channel, so that way you already have it now instead of me coming and bringing it up in the Friday edition, because I kind of like want to teach the model, the high frequency trading algorithm, just Friday's lesson. Okay. All right, so here's the pound dollar daily chart, and it swept a little bit higher. I really like this area here. I think we'll see that soon. Soon, like in a couple of days. No, not like that, but I think war would send it up very quickly. But I think they're just going to kind of keep working and pressing up into this high here. But ultimately, I like this high being taken out. I don't see anything bearish here. Even though it does this here, I don't see that as bearish. I wouldn't be surprised if we just trade right back above that tomorrow or Monday. All right, so here is the lecture for tonight. This is the hourly chart on the E-mini NASDAQ and March delivery contract. So obviously without the capabilities of being on my terminals and looking at all my charts and such, to combat boredom, which let me tell you this is something you do not want to do. Trading off of your cell phone, okay, that tiny itty bitty little screen. I was doing that, and I'll show you my actual trades. You can actually see where I actually executed, where I get in, where I got out. I was using partially the model that I'm going to show you tomorrow, and also just working with the intraday volatility. So I really wasn't trying to do a whole lot. But the question I'm getting a lot is, if I'm not taking the trades that are being taught in the framework that's in the YouTube channel, what trades am I taking on that live account? Well, when I'm doing latency tests, and I still have one more day of that for this month, and then I won't have a whole lot of high frequency enters and exits, okay? I'll show you what that looks like in the live account so that way you can see. It's nothing that's going to make any sense to any of you, but from an algorithm stance, it gives me data that I can work with. So again, you'll see right away and it'll probably end up being on YouTube, and things will be said about it that's out of context, and that's fine. I'll just rip that video down and several other videos that have my stuff in it, and then he'll lose his ad revenue. Wink, wink, nudge, nudge. All right, so anyway, we're looking at the hourly chart of the NASDAQ, and we're looking at how the market has come all the way back up into this SIBI, sell side imbalance, buy side inefficiency. And this up close candle, that's your bearish order block. Not this one. Look at the body. Did it close higher than that one? No. Did it trade higher? Yes. I don't care about that. This is a gap. I'm looking at the big beefy body candle. Why? Because that opening is the change in the state of delivery. Right there. As soon as we cross it, there it is. So it's all sell side imbalance there. Buy side inefficiency. But we have this small little area here that is always a wild card that could potentially be filled in, and we can see that actually happens here. Put that aside for a moment. You don't need to have that. You don't need to trade that. You wait. If it goes higher, this is what you're waiting for. Go up into this area, rebalance all of this in this small little area here. And now we're inside of the order block. Mean threshold, extending out in time. Didn't even hit it. So that's something you would expect anyway on an order block basis. So we trade above where the imbalance would begin, okay, at that change in the state of delivery based on that order block's opening price. It rallies above that and then breaks down. See that? Breaks down. This is an hourly chart. So if you break this down on the lower time frames, you'll see it takes out a swing low and it creates the imbalance here and trades right back up into it. Now watch what's going on. Look at the bodies. It's respecting that order block's opening price. This is what the algorithm's doing. It's remembering, going back to that change in the state of delivery. There. Sweeps it one more time just to fill in the area. Then displacement again. One more time, rallies up. Now this is an event on the economic data. So the news driver that came out this morning, I believe it was inflationary, it pumped up, took out the short-term high here, but left this high here. Then breaks down. Now I'm going to talk about this in a moment, how you avoid using the parameters I teach on the YouTube channel. So that way, yes, that model's good, but when don't you use it? Well, it's on an event like this. So you have to wait for something else in addition to, but we'll get into it. So we have a SIBI here. It rebalances back up to that opening price on the bearish order block. Right there. Hits it, rebalances, then sells off. Attacks the sell side liquidity here. And then we have old order flow in the form of this bullish order block here. And this old gap, which it finally made its way down into. I don't have the gap annotated because I didn't want to have all that stuff on the chart, but it's part of the analysis. 15-minute time frame, NASDAQ. You can see the imbalance here at 8:30. The news shows the aggressive repricing lower, taking out sell side here. I know it's no use to you now, and you probably go, well, you could have just told us this in the forum. I wanted to talk about this last night in the video I wanted to produce last night, but it's okay. I know some of you just don't want to believe that. But it swept below that and came all the way back up, rebalanced. Then it trades lower, optimal trade entry, and then starts working its way down into the sell side liquidity here and order block an old gap that was shown on the hourly chart. All right, let's tear this down a little bit more in detail. It's a 5-minute chart. 8:30 news. Displacement, aggressive displacement. This right here is manual intervention. This is not a lack of buyers and sellers. It's just manually overridden. They literally say, okay, it's time to crush the market, send it lower. It goes lower, trades into this low here, and starts working its way back up into this imbalance, which it does here. Now notice that 8:30 is being highlighted with this vertical line. What I'm teaching on the YouTube channel, so that way we can draw a contrast between what you're learning and what I'm teaching there. To the left of this 8:30, you have your first high here, right? Look closer. This high already went above this high. So we have the event ahead of 8:30, and they're allowing the 8:30 news driver to be the catalyst or smokescreen for why they reprice it aggressively lower. Anyone short here? It gets taken out there. They're not allowed to ride this down. These buy stops are paired with individuals that are looking for what I'm teaching you here to go short there. Selling short, it drives lower. They can take their profit, wait for this rebalance, which it does. Now look what's going on now after the rebalance, okay? Think about what I taught on the YouTube channel. You look at 8:30, go to the left, find a high, find a low, look for the liquidity, think about the daily bias, what's it likely to do, run the stops, look for a shift in market structure, is there a fair value gap, enter, run. Well, here, it's being delayed because of all of this, okay? All of this. So, unless you know what you're doing, you avoid all this movement. Oh, but I want to trade that. Well, I just told you how to do it. Look for the swing high right before 8:30. If it runs it, it's likely to go lower. I'm not telling you to do it by funds, because if you do it wrong, it could be very painful. But I already mentioned that. I prefer breaking down on the stock indices. There's really no reason for these things to be where they are. And I think, 6 weeks from now, we're going to be lower than we are. So, if we got war, and I keep talking that stuff, you don't want to hear about it, but it's a factor. You have to consider it. It's going to be an impediment to very smooth markets, but it'll increase volatility, which is really fun. But this event here is exactly what you'd be looking for. Like this would be the high prior to the 8:30 normally. And it runs above the high, then it breaks down, takes out the short-term low. Is there a fair value gap there? Yes. You wait for it to trade back up into it. Now here's where it gets a little squirrely. If you look at the idea of how I teach, usually staying out of the lunch, okay, the New York lunch hour. Here, the algorithm comes right back up into this area during lunch, but look how it does it. Swing high, presses above it, consolidates. Swing high here, presses above it right here. Swing high, presses above it, consolidates, then it leaves the lunch hour. So it hung around inside this imbalance for a while, all through lunch. Then it torques lower, swing lows are taken, imbalance, trade up into the imbalance, end breaker, high, low, higher high. Inside this candle, it can retrace back up into that, but not above it. Notice it doesn't do that. That's algorithmic. And going short here, or in this area here, target the external range liquidity in the form of sell side liquidity. Selling short, buying from willing sellers at a lower price. and trades down below there. And then it does multiple retracements back down in to dig into a deeper run into this low. If you were to think about how this was the ultimate target, because we ran down, then rebalanced. Why is it rebalancing? Because it's giving the opportunity for traders to get short in here. Okay? And they're going to let the buyers that are going to chase this all the way up to be their counterparty. So the sell side imbalance, it's all aggressive selling. To offer buy side, they allow price to reprice higher. Buyers come in, they chase it higher. Buyers are not pushing it up. That's not what's going on. The handshaking that's going on is when the algorithm is going up like this, yes, there's buyers, and it's providing a market for buyers because there's been an absence of them here. Not because there's no buyers or it's all sellers. It has nothing to do with it. It has absolutely nothing to do with it. It's just repricing so fast that the traders can't get their trades in. It's not, oh, there's not a willing buyer or seller interest. That's nonsense. There's buying and selling going on constantly, but the market's moving so fast, they're not processing. They're not reaching the market. So this imbalance here of sell side gets rebalanced with buyers being allowed to buy, and they want this to happen. Smart money wants this to happen because those buyers are coming in, and smart money is hedging into that as counterparty, selling to the buyers, selling to the buyers, selling to the buyers, above the high, selling to the buyers. Then they send it lower, take out the swing low, find your imbalance here. It runs right back up into it, and then you have to factor the lunch. So in your notes, if there's ever going to be a high impact news driver that's coming out at 8:30, this is a scenario that will likely occur where lunch is used to accumulate and then start the new leg lower. It doesn't happen a lot, but if it has a situation like this, anticipate this likely unfolding. And the market just keeps trading lower. And finally, this is a view of the weekly chart of the E-mini, and I'm using the front month. I think it's the NQ #1 exclamation, whatever the top one is. If you click on NQ in TradingView and use the NASDAQ futures tag, hit that, and the first one on the list, it's whatever one that has like an exclamation point. It's the continuous contract. I'm doing that, but showing it with the weekly data. So it's unchanged in every candle to weekly. We have the market trade lower, taking out this low after these highs are taken here. So we have buy stops taken and a break lower. Then we have an imbalance here after the low was taken out. See that here? Isn't this the very thing I'm teaching on YouTube? Yes. So all we're doing on a weekly basis, we're spending time in this area, which I'm thinking is likely to trade lower, and then aim down here. That's what I'm thinking. You know, I'm thinking it's likely to go down here. But we could just trade into the order block as well. We almost got down to it here. But ultimately, I'm thinking another pass down below this low here. All right, so I'll show you what I was dabbling in with my high frequency trading. This is something I utilize with the live account in between the setups, like I'm teaching you and I'm teaching the YouTube channel. So in between all of those setups, there's movement that you can participate in. All right, so you can see there's a new equity high, $40,061.96. Again, over here, this column cannot be manipulated by depositing. All right, so let's go over to the charts. All right, so here is today. All right, so let me widen this out a little bit. This was a $2,550 day. And I apologize. Let me see if I can get this to spread out a little bit better, as you can see. There you go. All right, so obviously I didn't get my internet connection back on until later in this afternoon. So I was plinking around on my cell phone. Please do not take what I'm showing you as a means of saying, well, I'm going to get in there and do the same thing. I'm going to get in there and scalp with the telephone. Don't do that, okay? Looking back, I wish I wouldn't have done it now, but to justify where the equity is on the live account, I want you to see it here. It's not deposited money. These people on the internet are just so stupid. It's ridiculous, but okay, that's what they got to believe in. Whatever. What are you going to say at the end of the year? All right, so I went short here. Now, after the move, yes, and then this is where high frequency algorithms are going to kick in. And I'm going to literally go in and teach you what to look for, how to hunt the setup, how to enter the setup, and where you're trying to get at. Okay. Now, this one happens to be a little bit more of a hole because I trusted where it was going to go. And let me go back here a little bit and see. Right below these lows here. That's what I was aiming for. Okay. So I sold short here with a high frequency entry and rode all of it down here. So that's not bad. I mean, almost $1,000. And then I'll let this go. And then over here, we had this big drop. And after that, what I was watching was how they were going to run the lows one more time. These types of trades here and here, when we're near old lows, as I'll teach it tomorrow, they are going to be the higher risk trade. But if everything is exactly what it should be, and you're nimble enough and you have experience, you can nickel and dime it and take 10, 15, 5, if that's what you want to do, handles out. I use this strategy sometimes to squeeze out a little bit of juice. Like if I'm having a day where like I was sitting right at $39,700 or something like that. And I went in and I was using that strategy, taking out the lows. Every time I would trade below a low, I'm getting out, I'm getting out, I'm getting out. And I'm just scalping that. Now, the problem you're going to have with that, if you're going to employ it, is sooner or later, you're going to get in a short, and this thing is going to rip your face off and go the other direction, especially a market like the NASDAQ, because it can literally scream 30 handles like real quick, which is fun when you're on side, but when you're off side, it hurts. You got to fix that. And sometimes it takes a couple trades if you're going to trade like this to fix it, but it's doable. So if you look at what I did here today, all right, you see here's 5 handles here, going short here and here, using that strategy, trading right below that low. And I don't want to take too much of the thunder away from what I'm teaching tomorrow, but same thing here, just about 19 handles here. And let me spread this out a little bit more. If you are a Thinkorswim user, okay, I have a very specific request that drives me crazy. I think that's probably the answer right there I'm looking for. It's double tap that and it does it. What I'm used to doing is grabbing somewhere in the chart, like on TradingView, and then after I adjust it a little bit one time over here, then you can click in the image of the chart and drag the chart up and down or all around. I'm so used to doing that, but as soon as you try to do that here, it creates these boxes, which is a nightmare. I'm so confused because I'm using technically 3 platforms: TradeStation, TradingView, and now this thing. So I'm always reaching for things that one platform doesn't have. So if there's a way, and it may not, it's okay. If you're going to tell me that all you have to do is double tap on this axis here, and it brings the thing square. Okay, I don't really like that, but if that's all I got, then whatever. But anyway, here's 5 handles here, and then a la black box type trader. Here's a 40 to 40 and a half to 21 and 3/4. That's a nice little move there. And I'm trying to do the same thing I just mentioned about not being able to toggle and move around well. 78 to 76.4. So that's kind of like a scratch. I saw something in there that didn't feel right, so I just closed it there. And I sold short at 755. And this one here, I got a little bit of burn on. It was 1 3/4 of a handle against me. That's the only losing trade I had. And then he had this one here, 39 to 33. So 5 3/4 of a handle there. So that fixes the error I had on that one. And then there's nothing over here. Oh, here it is. I'm sorry. Forgive me. Selling short at 765 and a half, covering it at 60 and a half. So that's 5 handles there. And then selling it at 36. I gotta get my eyeglasses redone. My prescription is weak. 36 1/4 and covering it at 20 3/4. So this is my version of high frequency trading. Now you can scale this to do a lot of 5 handles, 7 handles, 10 handles. You can do a lot of them, as I'll show you and teach you tomorrow. But you don't need a black box, Mickey Mouse operation to do that. Okay, you'll see it's a very, very simple process. You're going to use a time-based chart. It's logic that is going to be very familiar to you, just being applied to very, very low time frames, but with 1 and 5 minute market structure. So it's, like I said, it's fun. Like if you really want to get in here and get active with a demo account, practice. This is not a demo. Okay, you can see this is live. Okay, if I go right from here, to that, there you go. We're back in that. Here's the live account thing. So it's not like I'm switching accounts or anything like that. It's still the live account, and it's not the on-demand crap. Okay, like this thing. All of a sudden, everything goes away, and now I got $100,000. I wish it was easy. Just push a button. I got $100,000. Man, that's great. But that's obviously not what's going on here. So again, go back over here so you can see the business there. All of these trades equate to $2,550, and that's what I use to pump the account up. Now, what did I lose by not having my charts? I didn't have the clarity of having everything on. Hang on, let me get these positions and entries off. I didn't have the clarity. Let me go to a 5 minute. All right, so when I went short in here, I was looking at obviously this low being taken out. But because I already knew we're going to be in huge volatility today, I didn't trust the view of having just a 4-inch screen and not having everything at my disposal when I'm watching price. Like I'm usually watching several monitors, and 2 of which I'm toggling back and forth, different time frames. So I'm constantly getting a read on order flow, constantly getting a read on it. Now, you don't need to be that plugged in. Don't think that you have to be like that to be profitable. You don't. But if I'm going to be high frequency trading and I'm trying to, do what I normally do as ICT, not use servers or fraudulently doing things like these a-holes are saying on the internet, I'm using data that's framed on high frequency trading. And I can go in with lots of setups, and eventually over time, it'll allow me to do big runs in equity increases. But I got a little overzealous last night. I put a short on in this account, and I was selling short 5 contracts of the March Treasury bond, the 30-year Treasury bond. And as much as I wanted to hold the trade, I was like, you know what? I said I wasn't going to do this. I'm just going to take it off. So I took it off exactly where I got in at, and I just paid the commission. So anyway, I'll teach you obviously the high frequency model tomorrow, and you'll be able to find out how you can practice with high frequency trades. You also see how I run up, like on TradingView, just like I did on MT4. I ran up the demo accounts really fast, just doing entries on lower time frames over and over and over again. And as the equity builds up, I hold a bigger position. That's all it is. There's no secret to it. Okay. There's no hocus pocus. There's no necessity for fraudulent things. Okay. It's just simply looking at the price chart, knowing what it's likely to do, waiting for the setup, and then going in and engaging. And when it gives me the opportunity to get out, I close it. And over time, doing lots of them over the course of a few days, you can have serious equity increases. Like when I first shared this account, I think the balance was 23,400 something, and here we are at 40,000. So I guess that's a pretty good return. I mean, is it something that everybody's going to be able to do? No, but do I think this is realistic? Yes. If you're going to be really trying to focus and try to do well and build the equity up, in my opinion, this is realistic. Okay. It's not millions of dollars. It's not well, like I said before, it's not a Robin's Cup kind of performance. But who can't live on something like this? I mean, if you have money saved up, preferably you want to have, in my opinion, you want to have about $100,000, maybe $150,000 in the bank, and at the very minimum, if you're going to be trading 50 grand. And I know some of you are like, oh, man, I can't do that. There's all kinds of ways you can get there. You can go through funded trading programs, and make your bankroll that way. Use, other people's money to trade and let your equity be funded initially with that, and work on your craft at getting very good at what you do, and don't take a lot of risks. Okay, no, not big risks. I mean, obviously, we're taking risks every time we enter the market, but no big risks. No, let's see what happens type of trading, kamikaze stuff. You don't want to do that. But if you can get to the point where you can, and this is only one contract, one. Let me go over here one more time and show you. Like the NASDAQ here, if I want to trade one contract, this is the margin for it right now, $21,945. Now, when I was trading, when the account was at 23,000 or something like that, the margin was 17,000. Now it's gone up. I mean, it might be because of the volatility. They adjust the margins continuously all the time. But, even with a $40,000 account, I can't even do two contracts. It won't let me. And if I try to do, let's say, E-mini S&P. All right, and I want to do one contract of that. Click on that. It's $16,632, and it was $13,000 when I first got this account started. So it's gone up by $3,000 in margin, initial margin. So you have to maintain that all times. Contrast that with the bond market. If I want to trade just one contract of this, it's only 4,235, and I can capture significant price moves. In fact, I almost allowed this trading account to have a $10,000 win trading short on the bond market. I sold short 5 contracts last night at, what was it, 153, no, 152.28, 30 seconds. Yeah. And I was going to hold it with a full stop. So I was going to risk $5,000 to make $10,000 and just go to sleep overnight. And I thought about doing that, and then all of a sudden I was like, you know what? I entered this stuff on my phone, and I don't want to do something like that and run this account real quick. And doing trades like that, it kind of like removes the idea of why I'm even doing it, because I want you to see it as income, like to be able to do this trade and absorb some losses, okay, see some drawdown, give and take, but still come back. So I'm kind of like pantomime at the best I can what it would be like for a new trader sitting down with a live account for the first time, what they will see in their account, and how even negative numbers, negative, trade results doesn't diminish or make the ability to be profitable possible. It is possible. And transactions are just that. If you look at a loss as, well, it's failure, you're not going to be able to do this business and you're going to fail. Transactions, you can see the orders up here. That was the 5 contracts I put in at one time. And it would have been a payout of over $10,000 today. But I took it off, and the only thing I absorbed was the commission costs and the fees. So I got out at the same price I got in. It just wasn't moving, but I knew it was going to be moving today. And the likelihood of me being able to be in front of the chart without monitors, I just wanted to put in something last night and just be positioned for it. But there's plenty of bond trades to come. I can trade the index futures and the bond market and never, ever, 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 ever trade Forex ever again. And it would be fine. This is why I said to you before, some of you were always questioning me, what if the Forex market becomes impossible? Or what if they make it impossible and the algorithm is changed? And first of all, they're not going to change the algorithm. They may do a lot of manual interventions, which is really one of the problems with Forex, because you sometimes don't know when they're going to do it. So there's a lot more risk in that regard. But for scaling the money management side of the market, that's a perfect market, because you can literally buy and sell as much as you want. Whereas even with like a market like the bond or the futures, yeah, there's minis and there's micros, but you're still locked into whatever that point value is. Versus with Forex, you can scale it to whatever you want as long as you have the money to cover the minimum margin on it. It's scalable to very, very small degree. That's the only, in my opinion, that's the only benefit, and that's the reason why I taught Forex as long as I did. But if the Forex market stays consolidated like it is now and it's not really doing too much, I'm showing you, obviously, you can go right in here, trade micros, $5 per point for E-mini, $2 per point for E-mini NASDAQ. Yeah, it's it's doable, folks. I mean, you can still generate profits with that, and you don't need a very large account. But you do need to have some money, obviously. I'm not going to, well, let's see it. Let's go here and then I'll close the video because it's already getting too long and I got to do. This is the E-mini S&P. And if you click over here for one E-mini S&P contract, you need $1,663.20. That's the initial margin. By trading this, you're trading with the leverage that allows for one full handle, $5 per handle. So like a move from 45.60 to 45.50, that's 10 handles. That'd be $50. So you make $50 from that move right here. And you're probably thinking, oh, no, that's not enough money for me. Look, it's about percentage. This whole business is about percentage. It's not about what your bankrolls are on each individual trade. You're thinking about percentage basis. And by thinking that way, you're not worrying about the money. You're thinking about the percentage gain and loss, and you're managing it that way. And you let the effects of compound interest. Who cares if it's only $50 in the beginning? It doesn't stay like that until you build it up. That's what you'll use. But guess what? You can trade with $5 per handle and probably do better than your job pays you in a week. If you know what you're doing, easy, even with a micro. And I know it sounds insane, but it's true. You really can do it. And if you want to do, say, two micros and make $10 per handle, which would be like the equivalent, I guess, of the Dow. I'm not sure if there's any advantage in doing that, but I just don't like to trade the Dow. But you need $3,326. Listen, folks, if you get a funded account and you're able to do well and you're able to take money out, you can fund your own trading business and trade these markets with the money you pull out of the funded account. You don't need to have a lot of money to begin with, but you need to have the skill set. If you don't have the skill set, none of this is going to matter. It's a pipe dream until you know what you're doing, which is the reason why I beat it in your head all the time. Try not to worry about the money. Stop trying to be in a race to, I'm going to start trading with a live account. And you're only filling your head up with the negative stuff, the fear and the anxiety of performance. It has to be this way. You don't have to be that way, okay? And totally desensitize yourself to the results. Because if you're doing everything right, it won't matter if there's some drawdown. It don't make a difference whatsoever. None, okay? So hopefully this has been insightful to you. And tomorrow, like I said, I'll teach you a high-frequency trading algorithm, what to look for, how to set up the setups, and what to trade, how to trade, and where your stop should be, all that business. And that way you can go in and start practicing with a demo account on, say, TradingView. And until I talk to you later tonight, be safe.